Hey everyone, and welcome back to the Safe, Simple Sound podcast, College Planning Edition. I'm your host, Sam. Here, we focus on making sense of your money, helping you build strategies that are, well, safe, simple, and sound. We believe in empowering you to seize financial control and truly understand financial choices, especially when it comes to big goals like education. Today, we're tackling a specific government program designed to help with just that: the Education Savings Bond Program. Our discussion is based on an excellent breakdown that really clarifies how this program works. The core idea? It's about potentially using certain U.S. savings bonds for education and getting a significant break on the interest earned. Sounds great, right? But like many financial tools, the devil is in the details. Two key things jump out from the information. First, the potential for tax-free savings bonds interest is a fantastic benefit. But second, there are very specific rules, things like income limits, known as the MAGI limit, and the types of bonds that qualify, like Series EE bonds issued after 1989 and Series 1 bonds. Understanding these details is crucial for making informed decisions, which is exactly what we aim to help you do today. We'll walk through this program step by step, making it clear and actionable. Here's how we'll structure our conversation. First, we'll cover the basics. What is the Education Savings Bond Program? We'll explore the fundamental concept and the core benefit, that Savings Bond Interest Exclusion. Next, we'll dive into Are You Eligible? Qualifying rules for people in bonds. This is where we'll get specific about those crucial income limits, filing status, bond types, ownership rules, and age requirements. Then we'll discuss spending smart, qualified expenses, and eligible institutions. We need to know exactly what kind of qualified education expenses count and which schools fit the bill. It's not just any expense. And finally, we'll look at claiming your benefit, calculation, and tax filing. We'll touch on how the excludable amount is figured, especially if your bond proceeds are more than your expenses, and highlight the specific tax form you'll need, Form 8815. By the end of this episode, you'll have a much clearer picture of whether the Education Savings Bond Program is a good fit for your family's financial plan for education. So, grab your notepad, maybe a cup of coffee, and let's get started on demystifying this potentially valuable savings tool. One of the biggest, most daunting goals for so many people is funding education. Whether it's for your kids, grandkids, or even yourself going back to school, the costs can feel like a huge mountain to climb. So to start the episode, I want to zoom in on one specific tool that might help chip away at that mountain. Something offered by the U.S. government. We're going to cover the basics of the Education Savings Bond Program. Sounds official, I know, but stick with me because the core idea is pretty straightforward and potentially quite powerful. So what's the headline here? At its heart, this program involves using specific U.S. savings bonds for education. Now, the really interesting part is how you use them. If you cash in these particular bonds and use the money to pay for qualified education expenses, things like tuition and required fees, the interest earned on those bonds could potentially be tax-free at the federal level. Think about that for a second. You save money using the bond, and then you potentially get a tax break on the earnings when you use it for its intended purpose: education. This key benefit has a specific name. It's called the Savings Bond Interest Exclusion. That exclusion part is finance speak for you might not have to pay federal income tax on this bit of money. Now, why is this special? Well, typically, when you earn interest on regular U.S. savings bonds and cash them in, that interest is subject to federal income tax. You got to report it, you got to pay tax on it. But this program offers a potential way around that federal tax, specifically when the money is used for qualified education costs. It's a targeted incentive. It really highlights this fantastic dual goal the program aims for: save for school, save on taxes. It positions these bonds not just as a place to park your savings, but as a potentially tax-efficient strategy specifically geared towards tackling those education bills down the road. This actually brings up a good point for reflection. When you think about the different ways you could save or invest for education, 529 plans, custodial accounts, just a regular savings account, how much weight do you give to the tax-saving aspect? Beyond just the growth potential, how important is it for you to minimize the tax bite along the way, especially when costs are already so high. And another thing to ponder: what are your first impressions when you hear U.S. savings bonds? Maybe you think of them as something your grandparents bought, kind of old-fashioned, maybe just a super safe, slow growth option. It's interesting to see how they can fit into a modern strategy like funding education, especially with this potential tax perk. Were you even aware that using U.S. savings bonds for education with a potential tax-free benefit was a thing? So, to recap the absolute basics, the Education Savings Bond Program is a federal program allowing potential tax-free interest earnings on specific savings bonds. We'll get into which ones next time, when used for qualified education expenses. This is thanks to the Savings Bond Interest Exclusion, setting it apart from the usual tax treatment of bond interest and offering that save for school, save on taxes advantage. Now, before we move on, here's your food for thought for this segment. Take a moment after this segment to consider if incorporating tax-advantaged savings, like the potential offered by this program, aligns with your family's overall financial strategy for education. Does the idea of saving and potentially saving on taxes resonate with your goals? All right, so we've covered the basics of what the Education Savings Bond Program is. That cool idea of potentially getting tax-free interest on certain savings bonds when you use them for education. It sounds great on the surface, right? Save for school and save on taxes. But knowing what it is only gets us halfway there. The big question now, the one that really matters for your bottom line, is: are you actually eligible? This is where we need to dig into the specifics because, like many government programs, there are some key rules, qualifying rules for both the people involved and the bonds themselves. Getting this right is crucial to actually benefiting from the Savings Bond Interest Exclusion. So let's break down who qualifies and what makes a bond eligible. First up, who can claim the tax break? The rule is pretty straightforward here. You, the taxpayer, must be the one paying qualified education expenses, and those expenses must be for yourself, your spouse, or a dependent that you claim on your tax return. Think of it like this: the person whose education journey is being funded has to have that direct tax link back to you. So, paying for your claimed dependent child's tuition? Check. Paying for your own grad school? Check. Paying for your spouse's degree program? Check. Paying for your cousin's tuition, even if you're helping them out? Unfortunately, that won't qualify for this specific tax break. Okay, point number 2 is a big one, and it trips people up sometimes: the income restriction. There's a critical MAGI limit, that's modified adjusted gross income, that determines if you can claim this exclusion and how much. For 2024, the ability to claim the full Savings Bond Interest Exclusion starts to phase out, meaning it gradually reduces. If your MAGI is between $96,800 and $800 for single filers or heads of household. For those married filing jointly, that phase-out range for 2024 is between $145,200 and $175,200. Think of it like a dimmer switch. As your income goes up within that range, the potential tax break dims. And if your MAGI is above the top end of that range, $111,800 single HOH or $175,200 J for 2024, the light switch is effectively off and you can't claim the exclusion for that year. It's really important to remember these income limits can change each year due to inflation adjustments, so always check the current year's figures. Third, your tax filing status matters. This one's simple. You cannot claim this exclusion if your filing status is married filing separately. Any other status, single, married filing jointly, head of household, qualifying surviving spouse, is generally okay, assuming you meet the other criteria. Fourth, let's talk about the bonds themselves. Not just any U.S. savings bond will do. We need the right keys to unlock this benefit. Only 2 types qualify: Series EE bonds that were issued after 1989 and all Series 1 bonds. So if you have some older Series EE bonds tucked away from, say, 1985, while they might still be earning interest, they won't work for this specific tax exclusion program, even if you use the money for education. It has to be EE bonds issued in 1990 or later, or any I bond. And finally, point 5 deals with who owned the bond and when. This is about ownership and age. The qualifying Series EE bonds or Series 1 bonds must be registered in your name alone, or in both your name and your spouse's name as co-owners. Bonds registered solely in your child's name, even if they are your dependent, generally won't qualify for you to claim the exclusion. And here's a unique twist. You, the owner, or at least one of the co-owners if married, must have been at least 24 years old before the bond's issue date. The thinking behind this rule is often linked to ensuring the bonds were purchased by an adult, presumably with the intent of saving for education rather than just being gifted to a minor. Phew. Okay, that's a few hoops to jump through, right? As we're laying these out, it's really worth taking a moment to reflect. Considering those income limits, the MAGI limits we just discussed, how might this affect whether this program is a good fit for your household right now, or maybe even down the road as your income changes? And maybe you already own some savings bonds. Do you currently own any Series EE or I bonds? If you do, grab them mentally or physically later. And think about how those rules like issued after 1989 and the age 24 plus requirement impact their potential eligibility. So to quickly recap the eligibility checklist for the Savings Bond Interest Exclusion. 1. Are you paying qualified education expenses for yourself, your spouse, or a claimed dependent? 2. Is your MAGI below or within the phase-out range for the current tax year? 3. Is your filing status not married filing separately? 4. Do you have the right bond types, Series EE issued after 1989 or Series 1 bonds? 5. And were those specific bonds issued in your name or co-owned with your spouse after you turned 24? It's a checklist where you really need yes on all points to proceed. So here's your homework, your action item from this segment. First, take a realistic look at your estimated MAGI for the year. Are you likely to fall under those income thresholds? Second, if you hold any Series EE or Series 1 savings bonds, it's time to do a little digging. Check those issue dates. Are the EE bonds post-1989? Check the registration. Is it in your name and spouse's if applicable? And were you 24 or older when they were issued? Knowing these details is essential to determine if this powerful tax-saving tool is actually available to you. Okay, let's say you've gone through that checklist and things are looking promising. You meet the personal requirements, and you have the right kind of bonds. Fantastic. But we're not quite done yet. The next crucial piece of the puzzle is understanding exactly what kind of spending qualifies. What counts as qualified education expenses under this program's specific rules? And what defines an eligible educational institution? That's exactly what we'll break down in our next segment on Spending Smart. Let's address the next big question: what can you actually spend the money on to get that tax-free benefit on the interest? This is where we dive into Spending Smart, specifically understanding qualified education expenses and eligible educational institutions for this program. Because, unfortunately, you can't just cash in those U.S. savings bonds for education and use the money for any school-related cost and expect the Savings Bond Interest Exclusion. The rules are quite specific, but don't worry, they're pretty straightforward once you break them down. So let's start with the big one, qualified education expenses. What exactly counts? For the purposes of this specific program, the main things that qualify are tuition and fees that are required for enrollment or attendance at an eligible school. Think of it like the absolute must-pay costs to get your foot in the door and sit in that classroom. The sticker price, tuition, lab fees if they're mandatory for your course, that kind of thing. Now, just as important is knowing what doesn't usually count. This is where people sometimes get tripped up. Generally, room and board are not considered qualified expenses for this program. I know. Housing and food are huge parts of the college budget. But for the Education Savings Bond program, the focus is narrower. Also typically excluded are things like student activity fees, unless the school absolutely requires you to pay them to enroll, insurance costs, transportation, or expenses for sports, games, or hobbies, unless they're part of the degree program. So that elective scuba diving class probably won't count unless you're majoring in marine biology. Think about that for a second. How does the specific definition of qualified expenses, particularly excluding room and board, impact how much of your total education costs this program could potentially cover? For many families, tuition and required fees are significant, but they might only be, say, 50 to 60% of the total cost of attendance once you factor in living expenses. It's crucial to have realistic expectations about how much of your savings bond interest could become tax-free based on these specific rules. Okay, so that's the what you can spend it on. Now let's talk about the where. The funds need to be used at an eligible educational institution. This sounds fancy, but the definition is actually quite broad and good news for most people. An eligible educational institution is essentially any accredited post-secondary school. Think colleges, universities, vocational schools, or other post-secondary institutions that is eligible to participate in the federal student aid programs run by the U.S. Department of Education. This covers the vast majority of public and private universities, community colleges, and technical schools out there. If the school participates in federal financial aid programs like Pell Grants or federal student loans, it's almost certainly an eligible educational institution. So, are the types of educational institutions you or your dependents are considering likely to meet this criteria? For most traditional paths, the answer is probably yes. But if you're looking at a very specialized or perhaps unaccredited program, it's worth double-checking their eligibility for federal student aid. Now, here's a really key point. You need to match the proceeds from cashing in your bonds directly to these specific qualified expenses at these qualifying schools. It's like having a specific grant that says this money is only for textbooks bought at the official campus store. You can't just cash the bonds, put the money in your general checking account, and hope it all works out at tax time. You need to be able to show that in the year you claimed the Savings Bond Interest Exclusion, you paid at least that amount in qualified education expenses at an eligible educational institution. Keeping good records here is essential. This ensures you're truly using those tax-free savings bonds for their intended purpose, helping you save for college tax-free, specifically for the core educational costs. And one final quick note, something we'll touch on more later when we talk about calculations. If you claim other education tax benefits, like the American Opportunity Tax Credit or the Lifetime Learning Credit, for certain expenses, you generally can't use those same expenses to qualify for the Savings Bond Interest Exclusion. The IRS wants to prevent double dipping on tax benefits for the same educational costs. So, the amount of your qualified education expenses for the bond program might be reduced if you're also claiming those other credits. Okay, let's quickly recap the spending smart rules for the Education Savings Bond Program. First, focus on qualified education expenses, which primarily means tuition and required fees. Remember, room and board are generally out for the specific program. Second, the school needs to be an eligible educational institution, basically most accredited colleges, universities, and vocational schools. And third, you need to match the bond money you cash in to those specific expenses at those specific schools. So, here's your action item for this segment. Take some time, maybe later today or this week, and make a list of the anticipated future education costs you're saving for. Think about tuition, fees, books, room board, travel, everything. Then go through that list and circle or highlight the costs that would likely count as qualified education expenses under the rules we just discussed. This will give you a much clearer picture of how the Education Savings Bond Program might fit into your overall funding strategy. Now that we understand who is eligible, what bonds qualify, and importantly, what expenses in schools count, the next logical step is figuring out how much interest you can actually exclude and how you report it. So in our next segment, we'll roll up our sleeves and get into the nitty-gritty of calculating your savings bond interest exclusion and talk about the all-important Form 8815 you'll need when filing your taxes. Now, let's get to the part many of you are probably waiting for. How do you actually claim that tax benefit when it comes time to file? It's one thing to save the bonds and pay the bills, but it's another to make sure you're getting that potential tax break correctly calculated and reported. This is where we translate those savings into actual tax savings. So let's dive into the calculations and the paperwork involved. First things first, we need to figure out the starting point for our calculation. This isn't just your total tuition bill. We need to determine something called your Adjusted Qualified Education Expenses, or AQEE. Think of it like this. You start with your total qualified expenses. that tuition and required fees we just discussed. But then, you have to subtract any tax-free educational assistance you received. This could be things like Pell Grants, tax-free scholarships, or maybe tuition assistance from an employer. You also need to subtract any expenses you used to claim other education tax credits, like the American Opportunity Credit or the Lifetime Learning Credit. Why? Because the IRS generally doesn't let you double dip on tax benefits for the same expenses. So, your AQEE is essentially the amount of qualified expenses you covered with funds that weren't already getting some other tax advantage or weren't covered by tax-free aid. So, here's a moment for reflection. How might receiving scholarships or claiming other education tax credits influence the actual tax benefit you receive from this bond program? You can see how getting a big scholarship, while fantastic, might reduce your AQE, potentially impacting how much bond interest you can exclude. It's all interconnected. Okay, once you have that AQEE number, the calculation logic is fairly straightforward, especially in one scenario. If the total amount you cashed out from your qualified bonds, that's both the principal you originally invested and the interest earned, is less than or equal to your AQE for the year, then all the interest you earned on those cashed bonds might be tax-free. I say might because remember from our eligibility discussion, this is still subject to those MAGI limit restrictions. If your income is too high, the benefit phases out, even if your expenses line up perfectly. Now, what happens if the amount you cashed out from the bonds is more than your adjusted qualified education expenses? This is actually pretty common. Maybe you cashed out a larger bond anticipating higher costs, or maybe those scholarships reduced your AQEE significantly. In this case, you can only exclude part of the interest. Here's how you figure out that partial exclusion. You take the total interest you received from the bonds you cashed, and you multiply it by a fraction. The top of that fraction, the numerator, is your AQEE, those adjusted expenses we calculated. The bottom of the fraction, the denominator, is the total proceeds you received from cashing the bond's principal plus interest. Let's walk through that example from the reference article quickly. Imagine a couple cashes a bond and gets $9,000 total. That's $6,000 principal and $3,000 interest. Their AQEE, after accounting for everything, is $7,650. Since the proceeds $9,000 are more than the AQE $7,650, they can't exclude all $3,000 of interest. So they calculate $3,000 interest times the fraction $650 AQEE $9,000 total proceeds. That comes out to $2,550. So $2,550, the $3,000 interest is potentially tax-free. Again, even after you calculate this potential exclusion, whether it's the full amount or the partial amount, you still have to check it against the MAGI limit phase-out. If your income falls within that phase-out range we discussed earlier, the amount you calculated might be reduced further. If your MAGI is above the limit, unfortunately, you can't claim the Savings Bond Interest Exclusion at all for that year, even if the expenses and bond redemption otherwise qualified. That income check is a critical final step. So, you've done the math, you've checked your MAGI. How do you tell the IRS about this? You need to file a specific form with your federal income tax return. That form is Form 8815, and its full name is Exclusion of Interest from Series EE and IUS Savings Bonds issued after 1989. You'll fill this out, showing your calculations, and attach it to your Form 1040. And where does the final number go? The amount of interest you calculated that is tax-free gets reported on Schedule B of Form 1040, which is the Schedule for Interest Ordinary Dividends. There's a specific line there related to Form 8815. Now, thinking about this whole process, tracking the bonds you cash, keeping records of qualified expenses, potentially adjusting for scholarships or other credits, and then filling out Form 8815. Does that seem straightforward to you, or where might you anticipate needing more information or help? It definitely requires some good record keeping throughout the year, not just scrambling at tax time. So let's recap the key takeaways for claiming your benefit. First, calculate your adjusted qualified education expenses, AQEE, by subtracting tax-free aid and expenses used for other credits from your total qualified expenses. Second, compare your total bond proceeds to your AQE. If proceeds are less than or equal to AQE, all interest might be excludable. If proceeds are greater, calculate the partial exclusion using the ratio interest. Third, always remember to check the MAGI limit phase-out, as this can reduce or eliminate your final exclusion amount. And finally, report the exclusion by filing Form 8815 with your tax return, with the final excluded amount noted on Schedule B, Form 1040. Phew! That covers the mechanics of actually claiming the Savings Bond Interest Exclusion. Here's your call to action for this segment. When you have a moment, maybe later today or this week, do a quick search online for IRS Form 8815. Just pull it up and look at it. You don't need to fill it out now, but just familiarize yourself with the information it asks for. Seeing the form can make the process feel less abstract. And while you're thinking about it, consider how you would ideally track your qualified education expenses and your bond redemptions throughout the year to make filling out that form easier when the time comes. Good record keeping is definitely your friend here. All right, everyone. That brings us to the end of our discussion on the Education Savings Bond Program. We've covered a lot of ground today, aiming to make this specific government tool feel a bit more, well, safe, simple, and sound for your financial planning. We started with the basics, understanding how using certain U.S. savings bonds for education, specifically those Series EE bonds issued after 1989 and Series 1 bonds, can potentially lead to a savings bond interest exclusion, meaning those interest earnings might be tax-free when used correctly. Then we navigated the crucial eligibility maze: who qualifies, the importance of checking those MAGI limits for your income bracket, the filing status rules, and the specific requirements for bond ownership and your age when the bond was issued. We also clarified what counts as qualified education expenses. Remember, it's primarily tuition and fees, not typically room and board, and which institutions are eligible. And finally, we touched upon the calculation for the exclusion and the all-important Form 8815 you'll need when filing your taxes to claim this benefit. I think 2 points really stand out. First, those MAGI limits are critical. You need to know if your income fits within the range to even potentially qualify. Second, understanding that not all college costs are considered qualified education expenses for this specific program is key to managing expectations about how much benefit you might actually receive. Thank you so much for tuning in today and for being part of the Safe, Simple, Sound community. We genuinely appreciate you spending your time with us as we work together to understand financial choices. For more details, links to resources like the IRS guidelines, and maybe even a direct link to Form 8815 instructions, please check out our show notes on the podcast website. If you found this episode helpful in clarifying tax-free savings bonds for education, please consider subscribing so you don't miss our future episodes. Leaving a review or sharing this episode with friends or family who are also navigating education savings would be fantastic. It helps us reach more people trying to seize financial control. Remember, knowledge is power, especially when it comes to your finances. Keep asking questions, keep learning, and keep building that secure future. Until next time, stay informed, stay empowered. This is Sam, signing off from the Safe, Simple, Sound podcast.